European stocks and the euro kick off a new week in cautious fashion, with Spanish 10-year yields inching higher ahead of key bond auctions this week. So are lingering concerns about when or if Spain will seek a bailout overdone? Joining us now to discuss this is Phil Tyson, Head of Strategy for Interest Rate Products at ICAP. Phil, thanks very much indeed for joining us today. What's the market view this afternoon? Equity markets to continue to push on with these gains and therefore bond yields in the safe havens to rise a bit?
I'm not sure really. I mean, obviously we saw a big sort of risk-induced rally at the back end of last week, where we saw peripheral yields falling and core bonds suffering as a result. We've seen a little bit of a pause for breath today, and we've seen this kind of price action before after sort of big European policy announcements. There's a lot of optimism initially, and then it fades. Interesting that we've seen it beginning to fade already at the start of this week, and I just wonder whether this is a sign of things to come in the next few days, whether the core bond markets can regain a little bit of poise and make some fresh headway.
And in terms of the Spanish bailout request, if or whenever it comes in, is it priced into the market?
I think everyone's looking for the Spanish to come forth and ask for some sort of bailout. I think the big risk here is that the more there's some sort of delay in terms of Spain seeking requests, which is what we are fearing, the more tensions are going to rise again. That's going to put more upward pressure on Spanish and peripheral bond yields, and it's going to buoy the core markets again and potentially allow them to recover some lost ground. Yeah. There's a tendency for politicians to become a little bit complacent once yields have fallen again, and I worry that's going to happen again this time.
And Spanish 10-year yields rising from 5.88 to 5.98 today, ahead of two major auctions, as we mentioned this week. I mean, is this a screaming buy at this level? Because the ECB is effectively saying, well, we'll back them up, there's no problem there. Or do you wait, as our guest earlier said, till they get to 7%?
I mean, potentially we've got a 3 and a 10-year auction. I mean, the 3-year auction should receive some good support with the threat of ECB buying, and unless markets become a lot more sceptical in the next few days. I think the 10-year area, though, is potentially a little bit more vulnerable, as I say, to these concerns that it's going to take quite some time for Spain to potentially trigger any sort of ECB buying by requesting a bailout. So I worry that we might see some sort of steepening of the Spanish curve if we do see longer yields coming under some upward pressure.
Let's talk a little bit about Greece. These comments from Maria Fekter over the weekend saying only a few weeks extra, or, and I quote, a cost-neutral extension. What on earth does that mean?
Well, it's difficult to suggest, to sort of say initially what that means. I mean, potentially what they're suggesting is that they're seeking some sort of extension to the bailout conditions. Of course, the Troika are reluctant to do that because they don't want some sort of moral hazard creeping in here. It's going to make it that much more difficult for them to impose fiscal austerity elsewhere if there seem to be softening conditions for Greece. I fear that the big risk for Greece, though, is the IMF. They're pushing the European policymakers to sort of come forth with some sort of third bailout or some sort of restructuring, and they're sort of holding off, suggesting that's a route they don't want to go down. The risk for Greece is that the IMF sort of step back from the whole rescue package. I don't think we're going to see that happen, but I think that is the big risk for Greece.
And is that the same case then for Portugal? We saw these massive protests over the weekend. A possibility of a political rethink. Is the IMF the bigger risk in there as well?
Yeah, I mean, I think so. It's the same case for all these peripherals, including Portugal. Portugal has made probably much more progress, along the lines of Ireland compared to, say, sort of Spain or Greece. But it's still potentially vulnerable to any sort of political tensions and rising political uncertainty. If they do end up having fresh elections, the risk is they get a government in that's a lot more difficult for the likes of the European policymakers to deal with, and that's going to put upward pressure on Portuguese yields, and we're in a sort of potentially a Spanish situation there.
And finally then, in terms of rising yields, where do you put your money at the moment? What are you telling your clients to do?
Well, as I say, I'm not convinced that this is a style of a sustained rally in peripheral markets. So I think some of these core markets can come back, particularly bunds and treasuries. In fact, in terms of the US, we've seen quite a big move up move in US yields, and I think that as we get closer to the year end in the next few months, there is a growing feeling that maybe as Operation Twist expires, that we could see the Fed potentially adding to its MBS purchases with fresh Treasury purchases, and that could help put downward pressure on long US yields and flatten the curve there. So I quite like that sector.
Phil, thank you very much indeed for joining us today. That's it. My thanks to ICAP's Phil Tyson. Do stay with us. Reuters later today will quiz the French finance minister for his view on the EADS-BAE Systems merger plans and whether he thinks Spain should seek a bailout. I'm Nigel Stevenson. This is Reuters.